FOMC, NFP, CPI, PPI, and other high-impact news events are more related to the equity markets, and if the trading week is full of them, you should consider trading other markets like crude oil, for example, as commodities won't be affected by those news events. Here are the top 7 trades from last week using just the DR basic knowledge. Number 7, light crude oil futures, Monday regular DR session. Let's start with the trade opportunity from Monday's regular DR session on the light crude oil futures market. Looking at all 3 DR sessions and their relationship, we can see that they are forming a DR upside expansion model. The overnight DR session respected the ADR levels and expanded higher, while the regular DR session respected the overnight DR session levels, closing as a green DR box with a long confirmation. With the confirmation candle, we still haven't taken out the ODR session highs, which is something we ideally want to see to complete the DR upside expansion model. This makes the ODR highs a potential target for the session, and just above that, we have the plus 1.5 standard deviation level as well. While waiting for a retracement back into the DR with clear rejections, we can prepare ourselves by looking for extra confluences like intraday gap imbalances, volume imbalances, and previous DR session levels that might align with the current price action. There is one intraday gap imbalance that stands out as it's been broken to the upside and could become significant for further price action. If you're not familiar with weekly, daily, or intraday gap imbalances, check out my video where I explain these in detail. In addition, we have some previous volume imbalances inside the current defining range and 2 open magnetic volume imbalances that align with the closing price and IDR mid. These areas should be highlighted for potential setups. Looking further left, there's no interesting price action from previous days in terms of previous DR session levels that might influence the current setup. As we wait, price retraces back into the defining range. We get it to the tick rejection from the IDR high, which is the dashed red line, marking the highest close on a 5-minute time frame of the defining range box created in the first hour of the session. At this point, a previous intraday gap imbalance and volume imbalance align perfectly. And while you need to be quick, this presents a valid setup targeting the predefined plus 1.5 standard deviation level above the ODR highs. This trade demonstrates the advantage of being prepared and having potential scenarios lined up in advance. Price reached even higher, well above the target, and showing the power of multiple confluences and taking action when opportunities show up. Number 6, light crude oil futures, Tuesday aftermarket DR session. Let's continue with the oil market. The ADR started and closed as a red DR box with a big gap between the opening and closing price. Before trading the aftermarket DR session, always make sure to highlight the daily gap imbalance if one has been created. Half an hour later, we get a short confirmation perfectly aligning with the red DR box, which increases the probabilities for shorts throughout the session. As we wait for a retracement and clear entry signals, let's check if there are other confluences that might support a trade idea. At this point, there are no open magnetic wibs inside the range. However, we have 2 previous volume imbalances that were created during the defining range formation, and one of them lines up perfectly with the IDR low and closing price. Looking for intraday gap imbalances, which can act as restricted areas for price, we find one from the previous day's regular DR session that aligns with the current DR session lows. This might be of interest and should be noted. In terms of targets, the obvious choice is the next standard deviation level of 1, but there are a few other details that provide extra confidence for lower targets. Specifically, the previous day's regular DR session high and the open magnetic volume imbalances created the day before. Now that we are prepared for entering, we wait for clear rejections. There have already been 2 beautiful rejections from the defining range low, but price is too far away to offer a setup that gives you enough risk to reward while covering key areas with your stop loss. Patience is key. Wait for the next opportunity. Here we get another beautiful rejection, not only from the DR low, but also from the intraday gap imbalance. This is a valid short setup, with your stop loss covering the IDR low, closing price, and previous wibs and gibs offering more than 3R. Price reached its target and extended even further to the downside. This was a beautiful trade with stacked confluences that simply could not be ignored. Number 5, British pound versus the Japanese yen, Monday overnight DR session. Let's continue with a simple and basic DR trade. First, based on the relationship between the ADR and ODR, we have a DR downside model intact. At 5 a.m., price closed below the defining range on a 5-minute time frame, confirming shorts with a higher probability throughout the session. This gives us an early indication to look for potential short setups. At this point, we already have 3 strong indications for a short trade. A DR downside model being intact, a red DR box, and a short confirmation. Later in the session, price retraces back to the IDR low and rejects it 3 times very clearly. This is a strong signal to consider a trade targeting the next standard deviation level of 1.5. Another simple and basic DR trade offering more than 3R with multiple confluences stacked in your favor, making further downside very likely. Number 4, light crude oil futures, Tuesday overnight DR session trade. Back to oil, the Tuesday overnight DR formed and closed as a red DR box. Looking at the relationship between the aftermarket DR and the current overnight DR, it's clear that a DR downside model is intact. A few minutes later, we get a short confirmation increasing the probabilities for further downside movement in the session. At this point, we can highlight volume imbalances and intraday gap imbalances that have formed right before and during the session, which could act as extra confluences for potential setups. After the confirmation, price retraced back into the defining range and rejected the IDR low clearly. However, a valid setup targeting the 1 standard deviation level would offer less than 3R, which means we move on and skip the trade opportunity in this case. Price then retraces deeper into the defining range and shows rejections at the IDR mid, in line with previous volume imbalances. Entering here with a stop loss at the beginning of the retirement setup area offers nearly 5R, making it a valid setup. The target was almost reached, but unfortunately, price retraced deeper and you would have been stopped out if you didn't move your stop to break even. The good thing is that you were prepared for this scenario and now there's a high probability retirement setup in play. Price is now at the minus 0.8 retracement level, which also aligns with previous volume imbalances. You can protect your position by placing your stop loss above the defining range. You don't want to see price close above it, as this would make it a false DR session, which has happened only 21% of the time in the last 1,300 sessions. As the session comes to an end, there's no need to keep the risk at 1R anymore. You can move your stop loss to break even and let the trade play out. Number 3, gold futures Monday regular DR session. The DR intraday cycle started with the ADR inside the previous day's RDR, which is what I refer to as the DR range contraction model. The previous day's RDR session lows were successfully taken by the aftermarket defining range, and now we're moving into the overnight DR session. We get a large green ODR box followed by a long confirmation, increasing the probabilities of upside movement throughout the session. Inside the range, we have a couple of key points to consider. Open magnetic volume imbalances, previous intraday gap imbalances, and don't forget the ADR highs and lows, which align with the current session and could play an important role for potential trade setups. In terms of targets, we have several options. The next standard deviation level of plus 0.5, a previous DR session low, and the 1 standard deviation level. Selecting the right target in this example can be a bit tricky, but there's a simple solution. Once price gives you a potential entry signal, focus on where you protect your position first. Your target should reward you with at least 3R. Otherwise, it's better to skip the trade and wait for the next opportunity. Now, price retraces back into the DR and presents a first potential entry. It rejects the ADR high levels and finds its way back above the closing price. Unfortunately, if you want to cover the intraday gap imbalances from the aftermarket DR session, your risk to reward ratio is lower than 3R, even by going for the highest defined target, so you skip this trade for now. But patience pays off. A few moments later, price retraces deeper into the DR, now rejecting the intraday gap imbalances as well and offering an even better risk to reward with the same stop loss level. This results in a quick 3-hour trade with multiple confluences lining up and targeting the low-hanging fruit of plus 0.5 standard deviation level. Are you starting to realize the importance of being prepared for multiple scenarios? This trade shows exactly why you need to stay patient and plan for multiple potential setups. Number 2, Nasdaq 100 Futures Market Tuesday Regular DR Session. Let's break down the Tuesday regular DR session on the Nasdaq 100 futures. The RDR formed and closed as a green DR box with the closing price higher than the opening price. Shortly after the defining range formation, the 10:30 a.m. candle confirmed longs, signaling a higher probability for upside price action throughout the session. This is a very positive sign. While waiting for a retracement back into the DR with clear rejections, we can start preparing by looking for extra confluences. These include, for example, intraday gap imbalances or volume imbalances, and previous DR session levels that might align with the current price action. After searching for intraday gap imbalances from previous DR sessions, there's nothing significant that aligns with the current defining range. However, by checking for volume imbalances inside the range, we find one that hasn't been rebalanced, lining up with the retirement setup area and the opening price. This imbalance should definitely be highlighted as a potential point of interest for an entry during the session. Looking further left, we also see that the previous day's regular DR session lines up perfectly, with both its highs and lows at critical areas in the current session. This gives us additional context for potential rejections and entries. Now it's waiting time until price gives us clear rejections. In the middle of the session, price retraces back into the DR and quickly finds its way back above by reclaiming it. This candle rejects the previous day's RDR session highs, which we had highlighted as a potential confluence, and rejects the closing price as well. This is your opportunity to take your first bullet for the session, with your stop loss placed below the retracement low and the next standard deviation level of 1 as a potential target. If this setup fails, you already know where the second one would offer a great probability. And there you have it. Half an hour before the session ends, price reached the target. This trade perfectly shows that when you align a few simple confluences like the confirmation, the DR box color, and things like gap or volume imbalances or previous DR session levels, you can stack confluences and take action on a high probability trade. And we're coming to number 1. Light crude oil futures, Thursday overnight DR session. Remember what I said in the beginning of the video. If there's high impact news for the equity market, commodities like oil won't be affected by that and offer great trade opportunities. The DR box closed as a green one, with the closing price higher than the opening price, setting the stage for a potential upside trade. With the 4:10 a.m. candle, price confirmed longs with a higher probability throughout the session. Looking at the relationship between the ADR and ODR, we can clearly see that a DR upside model is intact, further supporting the probability for higher price action. A quick glance to the left shows several previous DR session levels lining up with the current DR session. Another great aspect of this DR session is that several previous intraday gap imbalances have been broken, and these imbalances now line up with current price action. In terms of targets, we obviously have the +1 standard deviation level in sight, but the +1.5 standard deviation level is also of interest as it aligns with the previous day's ODR highs. At 5 a.m., price retraced and rejected the previous day's ODR session lows before finding its way back above the intraday gap imbalance cluster again. This is a high probability trade. You now have multiple strong confluences. A green DR box with a long confirmation, a DR upside model intact, intraday gap, imbalance, rejections, and previous DR session levels aligning. All these things might seem overwhelming, but once you start to highlight them on your own, it becomes a routine and these setups become undeniable. I mean, just look at this, it can't get any better. And the best part? This is just the IDR Basics without any advanced data or additional insights. As always, I hope you gained some new insights of the DR trading strategy, which you can apply to your own trading, and I hope to see you in the next video. Have a good trading week.
We're gonna take on the world.